Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at the US restaurant sector, and my guest is O'Neill Global Advisors Senior Portfolio Manager Randy Watts. Eat a burger, grab a shake. Simple for consumers perhaps, but for the investor, the US restaurant sector can be a complex and layered menu. To whet appetites, the sector has continued to gain share of consumer wallets post-pandemic. Staffing shortages have eased as economic uncertainty makes a low-pay sector look more attractive to workers, and dining out has been relatively good value, with inflation hitting grocery prices faster than restaurants. But that gap is narrowing now, and a good chunk of the recent uptick in revenues has been due to higher restaurant prices, as certain chains flex their pricing power. Food and labour costs are up around 20% since the start of the pandemic, and margins for many operators are down from around 20% in 2021 to around 15% last year. So, is this the time for investors to take a bite? Well, I'm now joined by Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. Randy, welcome to Sectors Up Close. Thank you for being with us. As we mentioned there, pricing power has boosted some chains, Chipotle, Texas Roadhouse and Bloomin' Brands. To what extent is that on the wane now, and where does it leave them?
As you mentioned, the spread between eat at home and eat out has started to widen. So that is going to put pressure on the restaurants to stop pushing price as much as they have. In general, restaurants have done a good job of pushing price, and that's allowed them to have positive sales growth. Now, if you take out price, the restaurant industry has still been growing a little bit under 1%. So there has been net growth. And it's important to note, this is one of the areas of consumer spending that actually is positive, despite the inflation. But I do think that going forward, the companies are going to have to start to slow their price increases, because here in the US, the mainstream consumer has been getting squeezed. So I don't think there's that much more room they can take on price. However, we're hopeful as we move through the next 12 months that both food costs, with the exception of beef, and labor costs are going to start to decline, or at least go up slower than they have. So that should relieve some of the pressure on restaurants to keep raising price, and hopefully that'll also stimulate traffic.
Well, as you mentioned there, consumers are being squeezed, and they have been trading down from the slightly more expensive casual dining restaurants to fast casual, and then down again to quick service restaurants. Who are the winners and who are the losers in that process?
On a more secular basis, we really think fast casual is the place to be. It's not a huge percentage of the industry. It's much smaller than quick service, which is typical fast food. And we think those brands that are operating well there are going to be able to take a lot of share. So you mentioned Chipotle. That's a company that we think can double its store base, over the next few years. So I do think there's a lot of room for fast casual, in that the consumer will pay a little bit more money for a better quality food and better ingredients. And so those companies have been able to gain traffic and gain sales.
Now, one would assume that benefiting from that trading down phenomenon is McDonald's, but their stock actually hasn't done that well on a relative basis this year. What's going on there?
They have been pressured on the cost side, particularly on the labor side. Hopefully that's going to start to dissipate over the next year. The stock, I think, though, has suffered from the fact that the market this year, with obviously NASDAQ being up a lot and the S&P being up as well, with investors moving from more defensive stocks to more growth stocks. And I think many investors consider McDonald's to be more like a staple, a steady Eddie stock. And so that money has been leaving McDonald's, been rotating into more aggressive names, which have a bigger unit growth story. I do hope, though, however, that McDonald's margins, which have been under pressure, should start to stabilize and really even expand over the next 12 months. So we don't think it's a bad time to be looking at the stock. But right now, I think investors are more focused on growth. And so we really favor those unit growth stories more.
So if McDonald's is a staple for investors, presumably Shake Shack might be seen as a growth stock, at least in terms of performance. They're up nearly 70% in recent days, year to date. What's your view on them?
Shake Shack is a stock that investors look at and they say, wow, this company can have a lot more units than they have currently. It's obviously very understored relative to the big chain. Recently, an activist investor has also gotten involved So I think investors think there might be some kind of a positive shakeup that could act as a no pun intended, that can act as a positive catalyst for the company. And that's a stock that we do like on a growth basis, because we do think it's going to be a much bigger company over the next 5 years.
Some of the pizza chains appear a little bit unappetizing to investors. Domino's and Papa John's struggling this year. Domino talks of more people eating at home and the increasing costs of delivery becoming a burden. Tell us your view on that as well.
They probably have been hurt a little bit by the fact that there are more food apps that offer more delivery options than there were previously. So I think that's hurt Papa John's and Domino's a little bit. But I think in terms of home delivery, we still think Domino's is a long-term winner. They're extremely efficient. They have a great app, and they're getting an increasing percentage of their sales digitally. We do think it suffers a little bit from the staple type attributes like McDonald's, and that people are rotating again more towards aggressive unit growth expansion stories, and Domino's is farther along in its life cycle.
Randy, it's been great to hear your very excellent insights. Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. Thank you for being with us today.
Thanks very much.
And that is your look at investing in the US restaurant sector. I'm David Pollard, and this is Reuters.